If you've purchased property in the past couple of years, there's a good chance that you have some equity in that property. There's an even better chance that you got it at a low interest rate ranging from 2.75% to 4%. So what happens whenever you want to cash out that equity and reinvest it into real estate? Well, chances are that you're going to refinance into a 6, 7, or even an 8% interest rate right now. And I know that a lot of you right now with everything going on are asking yourselves, is it worth it for me to leave my beautiful croissant little 3.25% interest rate for a 7% interest rate on a cash out refi? And that's exactly what we're going to talk about on today's episode of Raw Built. So let's talk about it. There's a lot that goes into whether or not it's worth it to refi right now. But I think when you're running your calculations and your analysis, there's a metric that many of you are leaving out and you're not really factoring it into your numbers. It's a metric that we call ROE, return on equity. And the basic concept here is, can you get a better return with the equity that you have in your property than just leaving it in said property? Oh, so I thought you were gonna go.
I'm gonna go. You stay over here.
Well, it's fine. That was good. See, we're communicating. This is good. We leave it in. So for example, let's say that you invested money into a property, and let's say you put 20% down, and let's say that you're getting a 20% cash on cash return. Now you've gotten to the point where you've built up equity, but you don't necessarily want to tap into it because you're scared that when you refi, you're gonna have a 7 or 8% interest rate, and thus it stops you from ever reinvesting the gains or the equity that you have in said property. This is a really big missed opportunity for a lot of investors out there, because while it's nice to have equity, let's say you have a house that you bought for, let's say my house, $624,000 in Los Angeles, and it's worth $1.2 million. You have about $600,000 of equity. It's useless. It's useless to you. It's just sitting there. It's like nice to have it attributed to your net worth, but unless it's working for you, it's just a number on a piece of paper. All right, calm down. Let me explain, all right? There are really two types of people in this situation, right? There are people that want the higher net worth and just want to build that up so that when they retire, they can sell it, cash out, boom, good to go. But the other side of it is probably you, if you're watching this, which is you're an investor and you want to use your money to the best of its ability and keep redeploying it so you can keep making a return on the properties that you buy. So you often hear of people that say that leaving cash in a bank account is useless because cash is losing its value every day with inflation. You could almost make the same argument for equity. You have equity in a house, the house continues to appreciate, so that part is nice, but you're effectively leaving money in the house as if the house is a savings account, your equity is that cash, and it's not losing value, but it's not really doing anything with you, right? And this is the powerful concept of return on equity. Return on equity basically says cash out your money, take your equity, and use that money to reinvest into more real estate and make a return on that money. So let's talk this out a little bit more, and we're going to talk about my Los Angeles house specifically because I'm actually looking at carrying out a big flip, rehab, and actually doing a cash out refi on this property and really executing on what we're going to be talking about today. So currently I have about $500,000-$600,000 of equity in that property and I have a 3.25% interest rate. So here's the general idea. On that property, I currently cash flow between $2,000 to $3,000 per month roughly. So that's $24,000 to $36,000 that I make in profit on that property after all of my expenses. But I have $500,000-$600,000 worth of equity. We're gonna say $500,000 to keep the math easy. So what I'm gonna do in this situation to maximize my equity is I'm gonna do a cash out refi. I'm gonna pull as much of that $500,000 out as I can, which should be about 75%. So 75% of $500,000, Caleb, $350,000? $375,000. That was close. That's pretty good. So in theory, if I do a cash out refi, the bank will re-amortize my loan over 30 years, write me a check for $375,000, and then I'm free to go and gamble in Vegas. Just kidding. Or am I?
Don't say anything about gambling. It's not gambling when you know you're going to win.
All right, so I get $375,000 from the bank. I deposit that in my bank account, and I'm now free to use that money for anything I want. So now the idea is, how can I deploy that $375,000 in a way that makes me a return? Because before, that $375,000 was just sitting vacant, unused in my house bank account. But now I actually have that tangible money that I can use and reinvest into another real estate asset. So now let's think about this. If that $375,000 stayed there, wouldn't have been able to do anything with it. At the very minimum, if I invested in the stock market, S&P 500, and any more stable standard investments, I should be able to pull a 10% return, which would be about $37,500 per year just for having cashed out refied. But keep in mind that my interest rate is now higher and so is my mortgage. So I do have some costs associated with that cash out refi. But me as a real estate investor, I don't want to put it into any of those more standard investments. I want to deploy it back into real estate where I'm generally looking to get a 10 to 20% cash on cash return. So if I'm able to get a 20% cash on cash return, now in theory, I'm able to cash flow an extra $75,000 from that $375,000 that I pulled out in equity. That, my friends, is the concept of return on equity. How can I pull money out of my house and how can I deploy it and make money on that money? See, it's really great because once you have a ton of real estate, like me or my friends or my peers in this space, that appreciation keeps growing and growing and growing, and ultimately you'll have millions of dollars of equity over the course of 20 or 30 years that you can keep cashing out and keep deploying into more real estate. So it's like recycling your money to make you more money. It's a really, really powerful tool that I don't think enough investors are taking advantage of, myself included, because I do have really nice low interest rates. And so it's really hard to break that barrier to reinvest my money so that I can maximize it. But what I want to do is go back to the studio, talk about this LA project a little bit more, and break down the numbers and show you how pulling out money and paying a higher interest rate will ultimately make me more money. All right? Is that cool with you, Mr. Sweaty Man? I'm the sweaty man here. All right, let's do it. Let's go. And I'm back in the studio and I'm looking at my numbers and actually have a little bit more equity than I thought. So I always say that my house is worth between $1.2 and $1.3 million. The estimated home value based on this website is actually pretty close to what I believe it to be, which is $1,281,000, meaning that my estimated equity is about $579,000 because my unpaid principal on the home is $701,000. So I just wanted to hop into my portal here to confirm that my interest rate actually is 3.25%, which it is. So currently the amount that's due every month is $43.45. That is my current mortgage after my escrow has been reassessed. For the last 2 years, it's been about $4,200 per month. So now what I want to do is actually calculate how much of that equity I can actually pull out. Usually it's about 75%. If it's $579,266, that is $434,449. That's 75% of the equity that I have. So give or take about $430,000 is what I can pull out from my home. So here's exactly how that works. If I pull out that money, it's not like I just am given that money for free. It now gets re-amortized over 30 months and gets added to my unpaid principal of $701,000. So for reference, it'd be $434,000 plus 701. And my new mortgage would be about 1.136 million bucks. Now amortized over 30 years at a higher interest rate. So let's plug that into the calculator and see how much my mortgage goes up if I were to pull out that cash. So I've gone into this calculator and I've replicated my current mortgage as it stands at the amount that I currently owe. Now if we go in and do what I just talked about and pull out the equity and re-amortize it, here's what my new mortgage is gonna be. All right, so here's where it gets interesting. If I was still at 3.25%, my new mortgage would be $61.97. However, with current interest rates, we know we're gonna be between 6.5% to 7.5%. So I'm gonna put 7% here as a middle ground. Could even be higher than that. But now my new mortgage would be $88.11 in this scenario, meaning that every month I'm paying an extra $44.66. And over the course of a year, I'm paying an extra $53,592 in interest. So now here's the question. Can the $434,000 that I pool make more than the extra $53,000 that I'm paying in mortgage expenses and interest? I think the answer is yes, but it's pretty close because when you're weighing your return, there's a few things to think about. If I'm making a 10% return on this $434,000, I'm only making $43,000 a year, meaning I'm actually making less of a return than the added mortgage and interest expense. But keep in mind, I'm always shooting for a 20%, meaning that'd be about $86,000. So I would make a delta of 30 grand if I actually hit my marks. I'm actually okay these days with the 10 to 15% return, which would actually put me closer to even with the added taxes and insurance. However, keep in mind that when I buy real estate, I'm not just getting cash flow. I'm also getting the appreciation, right? A house that you might buy for $624,000 that might appreciate to $1.281 million. I'm also getting the accelerated depreciation, the bonus depreciation from being a real estate professional or using the short-term rental loophole, and I'm able to use that depreciation to wipe out a very significant portion of my taxes. So if you're just looking at things from a cash flow perspective, it might be closer to 1-to-1 with current interest rates. But if you're an investor that looks at the big picture, then you know that you're getting cash flow, debt pay down, appreciation, and tax deduction. And those four things are a very, very powerful thing. So I encourage you not to just look at cash flow when you're analyzing a property. Look at the other components that make up a good real estate investment, which is ultimately why it's always going to be worth it to use my equity to put into more real estate so that even if the cash flow isn't as good as I'd like it to be, obviously I want it to be as high as possible, I still have the other three big pillars that are watching out for me. The more you know. Sorry, I don't mean to get in the weeds of this, and honestly, explaining return on equity can be a lot more simple than what I just did. However, it's complicated. It's a very nuanced thing, and investing in real estate all comes down to your personal investment choices and policies and points of views and philosophies and all that kind of stuff, right? So So anyways, that's kind of surface level in this particular investment. I'm paying an extra $53,592 every single year to cash out refi. Let's talk about the actual use case of this property. Currently, this particular property makes me $5,500 roughly every single month. And then I also make an additional, on average, $2,000 to $3,000 every single month from the tiny house in the back. We'll say, I'm gonna put it low. I'm gonna put $2,200 on the tiny house in the backyard. So when you add that all together, $2,200 plus $5,500, I gross $7,700 on that property times 12, which comes out to $92,400. My total expenses on the property are a lot less because, as you saw, my mortgage is $4,400, pay a couple $100 for utilities and some lawn maintenance and pest control, but overall, I make decently good money on that property. Now, if I refied and I was paying $88.11 every single month, my new expenses are gonna be $105,732. So I would actually be losing money. However, what I'd like to do with this property is add square footage, completely remodel it so that I can make more money. So I've been running comps on this property trying to figure out how much money it's gonna make me post remodel. I've got my ideas, but I've also got a friend that's pretty good at this. She currently does this in the LA area. So I'm gonna give her a call really fast and get her thoughts on what she thinks I'll make every single month. You know, I always feel like Pawn Stars when I'm like, but I've got a buddy who actually specializes in this. Let me give him a call really fast. I'm thinking about doing a pretty major overhaul on this property. I want to add square footage, but if I were to add 2 bedrooms, 2 baths and make it a 4-3, do you think that would dramatically increase revenue?
Yes. For one, there's a need for 4 bedrooms.
So with that in mind, I looked at the rentalizer for my 2-1. It was actually pretty close. It says on a 2-1, I'm going to gross $57,500. Like I said, my average is $5,500, meaning that I'm making about $66,000. So the rentalizer is actually not that far off. Changing my configuration around to a 4-3 basically changes the revenue quite a bit, and it boosts it up to $113,000.
Yep, that's pretty accurate.
If it's a 4-3, it's going to bring $113,000 a year. That's effectively $9,400 a month. And I could still rent the tiny house in the back separately for another $2,000, $3,000 a month like I do. If I did it that way, I'd actually make probably the most money. I think I'd make about $140,000 to $150,000 with that strategy. Any reservations about how I'm thinking through that?
No, I think you're thinking correctly. So our 4-3s in that area are getting anywhere from $10,000 to $13,000.
Really? Okay.
And also you have to think your area is known for really large single family homes. And it's probably a lot of multi-gen families in that area. So I do think there's a need for that.
I'm trying to decide, is it really worth me putting $300,000 to $400,000 into it? Or if I should just kind of let it do its thing, make a little bit of money for me and then focus on another property.
I would make it to a 4-3.
Okay. I expect you to help me fill it up though.
Definitely.
Let's recap the numbers there a little bit. Currently, my house as a 2-1 is grossing about $5,500 a month. With this remodel and dumping about $300,000-$400,000 into it, I can actually expect to increase my rents to about $10,000 a month on the low side, meaning that my gross would be $120,000. However, as we discussed, my mortgage is going to be $88.11. So over the course of a year, it'll cost me $105,732 to run this property, just in mortgage expenses. We'll call it $110,000 after all my other expenses like lawn, pest control, utilities, everything like that, right? So my profit on that's going to be about $10,000. But keep in mind, I've got my tiny house in the backyard that makes me about $25,000 a year. So total, we're looking at about a $35,000 profit on this property every single year on the low side. But however, on the high side, we're actually looking at making $15,500 a month, about $13,000 for the main home, $2,500 for the tiny home, and that would come out to $186,000 per year, meaning that my profit would be about $76,000 a year to do a full remodel. Now I have to ask the question, is it worth it for me to remodel this home for 9 months, to pull out $400,000 plus, to do a cash out refi, go through all the hullabaloo, to make a $76,000 profit every single year? Maybe not, because $76,000 is just over double what I'm already making for the most part. Meaning that right now I make about $36,000 a year, roughly. So it's $36,000 a year for about $400,000 spent on the high side for this remodel. It's a 9% return. Not the greatest return, right? I want to be at a 10% to 20%. But there are some intangibles here that I do want to talk about. Those intangibles are that it's my house in LA, and I've always wanted to remodel it, and I've always wanted to have a nice big house in Los Angeles that my wife and kids could go stay in. And every time we go now and we stay at this 2-1, it's really frustrating. It's small and we have 2 kids and there's only 1 bathroom. bathroom. When guests come over, there's one bathroom, and it's a whole thing, right? So from a financial standpoint, maybe it's not the most home run way to use my equity, but from an intangible standpoint, I can effectively do it for free because I've got equity in my home. I can pull out, remodel this home, still make $76,000, and then just keep it as a rental and rent it for another 30 years. And even though the note's now gonna be about $1.2 million, other people are gonna pay for that, not me. So really, for me, I think I'm good with that. Own dope homes, dream homes in places that I want to be, let other people pay for it, and as long as I can make some profit, in this case $76,000, then I think it's worth making $76,000 a year so that I can have an amazing home in Los Angeles, California, and it's what I'm doing this for, right? I mean, all of us want to cash flow and get rich and be wealthy and all that kind of stuff, but I think it's important to remember why we're getting into this business to begin with, and for me, it's because I want cool homes, and this will be a full circle moment for me that this entire real estate journey is allowing me to potentially remodel the first home that started it all. And that's good enough for me. Catch you on the next episode of Rock Belt. I'm dumb because I just sat here for an entire video and told you about the cash flow that I'm going to be getting from this property, but I didn't even tell you about the best part, the forced appreciation, which is how I'm basically adding value to this property by undergoing this entire project. So I'm adding 400 square feet to my property and totally going all out with the remodel. And looking at similar comps in my neighborhood, I think that I'm going to be adding $700,000 of value to my property. $700,000 in equity that gets added to my net worth. It's a beautiful thing because not only will I get my $400,000 back when I do my cash out refi, I'll also get an additional $150,000 that I can cash out that I can then use to go and buy more real estate. So really, my first home is kind of a home run. I just got a lot more excited about this project. Catch you on the next episode of Rob Built. Bye.